Hello, friends. I hope all of you are fine. I'm preparing this video on the in the continuation of the this chapter two. Earlier means I've completed the chapter one of this ICAI Institute material. So this unit. It is focusing on the classification and the measurement of the financial asset and the financial liability. So in the previous chapter, we have discussed about what is a financial asset, what is a financial liability, then the equity and the de-scoping from this accounting standard, that is of Ind AS 109 and Ind AS 32. Okay, and the Ind AS 107. So now coming to this one, so so in this I have prepared at a very high level the snapshots. So what are the things which are covered here? So because this is a big chapter, I think this is the biggest chapter in the financial instrument. It contains around 68 pages of the CA Institute material. So just for the convenience at a high level overview, so I've divided this chapter 2 into three parts: the financial asset, then the financial liability, and then and then the others. You can see this is the financial asset. So I've used the abbreviation FA. So so FA, then this one is the uh, financial liability, and this one is the others. Okay, and in the financial asset, what we will be covering the classification, this one the classification, then the measurement, this one. So in the classification, we will be covering there are the two tests, that is a business model test, and there is a solely payment of principal and interest. So SPPI test in the short form. So these two tests will be covering what is the meaning of the business model, and then what is SPPI. All those stuff we will be covering. Okay, so this is the one thing, and and the offshoot of these tests will be your whether if like that the particular instrument is the amortized cost, it should be classified under the amortized cost AC, or is it to be classified under the FVOCI, that is a fair value through other comprehensive income, or FVTPLs, that is a fair value through P&L. So these are the three classifications on the basis of these tests. So these are the tests. Okay. So on the basis of the test, on the basis of the result of it, whether it will be classified under the amortized cost, FVOC, or the FVTPL, that we will be talking. Okay, so this will be the classification. And then in the measurement, how, like if it is classified under the amortized cost, so then how it will be measured initially. So normally the initially it is measured at the fair value. So that is governed by the Ind AS 113. So normally initial measurement it happens at the fair value. But there is a one exception of if there is a receivable where uh, uh, there is a receivable, so then it can be classified at the transaction price. But that point it is not covered in the institute till now in this chapter 2, but if it will be covered in the future, so in the later chapter, so then I will be picking that thing, the receivable, as an exception for it. Okay. But normally the receivables it is classified under the amortized cost because of the significant financing. So significant financing, so that will be covering, like means as and when, like means we will be going through the chapter. So in the initial recognition, so they have covered, they have broadly divided into the three subparts of it. The off market terms. So the off market terms, like your some transactions are happening not at the fair value, it is happening at the uh, other than the fair value, like uh, the parent company is giving the loan to the subsidiary not at the fair value, not at the market interest. So then it will be covered under the market off market terms. Similarly, the company is giving loan to its employees at lower than the market interest rate. So that also it will be covered here. And similarly, in the lease also, uh, the for the security deposit. So and the security deposit is the interest free, interest free security deposits. So those will be covered in the off market terms. So majorly the parent is giving uh, the loan to the holding to the subsidiary, so that will be covered here. So parent to subsidiary, then here it will be your the company is giving to company is giving the loan to its employees at a cheaper rate. Then third one in the lease contract. So all this we will be covering once we will be going through the chapter. Okay. Then the transaction costs, how the transaction cost to be treated, what are the different type of the transaction costs. So that is what they're talking about. Like in the financial asset, the transaction cost it gets added, and in the financial liability, this transaction cost it gets deducted. Okay, so this we'll be talking about. Then the specific transactions also that we will be taking care of. And then in the subsequent recognition, how the in the amortized cost, how the how this valuation, how this recognition is happening. So here this the EIR concept is coming in this one, effective interest rate. Okay, for the amortized cost. So for this EIR, I have prepared one very small video that is of around 20 minutes. So in that I have explained what is the meaning of the EIR and how it is different from uh, the straight line amortization of the discount and the premium which you have learned in the CA Inter. So this is a new concept. So effective interest rate. So this is for the amortized cost. Then similarly for the FVOCI, how the fair value, like after the initial recognition of how the fair value it is recognized. So there this we call it as a mark to market. So a mark to market it is going under the OCI reserve. Okay, and for the FVTPL, that the mark to market, that is a fair value movement, it is going under the PNL. So this is what it is captured under the subsequent recognition. Similarly, here also in the financial liability, the classification, then in the measurement, you are having a specific transaction. In the financial liability, you are having two type of the classification, that is the amortized cost and the fair value through P&L. So in this, you are not having the FVOCI concept here. So we will be discussing about the conditions. Once the conditions which are for the amortized cost, if it gets satisfied, so then it will be amortized cost, otherwise it will be the FVTPL. Okay, and in the others section, we will be discussing about the reclassification between the between the amortized cost to the FEOC or FEOCI to the FVTPL or vice versa. So that we will be discussing. So this reclassification, it is of the financial asset only, not of the financial liability. So that means if anything is if any instrument under the financial liability is classified under the amortized cost, so then it cannot be reclassified to the FVTPL. But in the financial asset, it is allowed, but here very stringent conditions are there, like means the business model test. If the business model is getting changed, then only that this reclassification is allowed for the financial asset. Okay, and this is a and then the last topic, that is of the impairment of the financial asset. So that we'll be discussing. So this is a broad overview what what the chapter 2 is talking about, that is a financial asset. In the financial asset you are having the classification, then the measurement, and similarly in the financial liability also you are having a classification and the measurement, and then in the other section you are having a reclassification and the impairment topic. Yep. Okay. At a high this thing before starting, so this okay, so this later on we will be discussing about it. So I have just prepared the quick snapshot, like the main concept. This is like your eye view. So if you know about it, so then it will be easy for you to categorize. Okay, so this we will be later on discussing once we progress with the chapter. Okay, so now coming to the chapter. Okay, so the recognition and the subsequent measurement. So this is what I was referring to. uh, okay, recognition, that is a measurement and the subsequent initial and the subsequent measurement. Okay, so so just we are following our approach. Um, So just we will keep our approach as it is, like we will be reading line by line, line by line of this chapter of this CA Institute material. So then wherever I think, then I will explain it to you. Okay. So all the financial financial assets and the financial liabilities are measured at their fair value upon the initial recognition. Okay, so this is what I've told you, like in the beginning, once you will be recording the financial asset and the financial liability initially, so at the inception, you call it at the inception. So at that time, it is recorded at the fair value. So here it is not talking about the exception. So in the exception, there was it is there in the IFRS 9, that is for the receivables. Like if in the receivables, sorry, in the receivables where there is no significant financing, so then it will be recorded at the transaction price instead of the fair value, where this transaction price is different from the fair value. Okay, just keep it in mind. But if it is mentioned later on, so then I will come back on this one. Okay, the classification of the financial asset and the financial liability drives their initial and the subsequent measurement. Okay, so the classification, on the basis of the classification, whether it's amortized cost, FVOCI for the financial asset, or FVTPL, fair value through P&L. So on the basis of that, the subsequent measurement uh, will be there on the basis of the classification. Okay, so the financial asset, the key elements to determine the classification. So here it is talking about the business model test. So this particular 2.2, it is talking about the business model test and the SPPI test. So these are the two tests. So in the business model at a very high level, uh, if you are having, uh, okay, so just quickly I will just tell you. So in the business model, so I'm writing in a short form. So in the business model, if your intention to hold the asset, normally this is at the entity level, we take it, not at the transaction level. So this business model, so this is like the if the entity uh, if the entity is how means why the entity is keeping that financial why that entity is keeping that instrument, uh, like if it is purchasing any instrument, so then what is the intention of purchasing it? So obviously to earn the profit of it, correct? So here the profit, it is earned in the two way, like you are like if you are having uh, if you have given a loan, correct? So on the loan, the entity can so loan of 5 years, correct? Just I'm giving one example, loan of the 5 years, it has given to one customer. So on this loan, the entity means like the bank has given a loan to the customer, like in India. Okay, so bank has given a loan to a customer, uh, so here of the 5 years, तो 5 साल के लिए ऐसे दे रखा है इन लोगों ने. So sorry, uh, so here like the bank will be earning the interest, correct? So the customer will be paying the interest on it, and plus the bank can sell this loan also in between. So here the two type of, so there is a two way to earn the income. One is the interest and the another one is like to sell the loan in the market. Okay, so that is another thing. So if the business model it is to have only the contractual cash flow. So here like the contractual cash flow is to get the interest and the principal. Okay, in this example, like so here this bank is holding this loan for the 5 years to earn the interest and the principal from it. So this is called as a contractual cash flow. That is the one thing. So if that is an intention, so this is the one in, so this is the one way like to earn the profit for the bank. Similarly, the another one is the CCF, that is a contractual cash flow and held for sale also. Like if something happens, like if the if the interest like if the interest goes up, so then so here the bank has given the loan at a very cheaper rate, say 5%. Okay, and if the interest has gone like so, suppose at the end of the second year, the interest has risen to 7%. So then it's a loss for the bank because it is getting 5% from that customer if it's a fixed rate interest. So, but on the same amount, the bank can earn 7% if it gives to the new customer. So this is a loss. So like here, what the bank will do, so bank will sell this loan. Okay, sell this loan, and then whatever the money it gets, so that money it can reinvest at the 7%. So that is the thing. So held for sale. So whenever the situation comes, so it depends. Okay, it's not a hard and fast rule, but it depends. So here, like you are having an intention to earn the interest and the principal, the contractual cash flow, interest plus principal, plus if if any situation comes during the 5 years here, so then the bank can sell that loan also. So this is another model. So this like we call it as a model two, this one. Okay, and this is a model one. Okay, so in the model one, so here you are having the intention to earn the interest and the principal only. So this will be classified, this loan will be classified as the amortized cost, because here uh, you are not concerned with the interest rate what is going in the market. So it means you are immune to it. Okay, because here you are holding that asset till the maturity. So that is the one thing. So this is the amortized cost here. But in this one, you are getting impacted from the market rate, market interest rate fluctuation. Because here you are deciding on the basis of the market interest rate fluctuation whether the bank should uh, sell it or to keep it. Okay, so here this if this model is followed, held for sale or the CCF, the contractual cash flow, so then this loan it will be categorized, it will be classified under the FVOCA, the fair value through OCA. So this is the thing. So this is just I've given you a very high level overview what is there in the business model test. Okay, and then in the SPPI, what is there in the SPPI? Solely payment of the principal and the interest. So here in this example, like in this one, so in this you are having the interest and the principal only. That's it. Okay. So like if you are keeping it for the 5 years, so then you are earning the interest and the principal. Now here this interest, it is also having the definition what is included in the interest. So that we will be discussing here. So like the market interest rate. Okay, in this one the market interest rate plus the credit spread. Credit spread is your like for the customer, like if you are giving instead of the customer, if you are giving to the company that loan, so for each company normally you are having its own credit ratings. So on the basis if it is given to like if it is given to the company Adani, okay, which is having a higher risk as compared to giving the loan to Reliance. Okay, because their credit rating of Adani is lower as compared to the credit rating of Reliance. So the credit spread. So credit spread, it talks about the credit risk. So the credit risk of the Reliance, the credit spread of the Reliance will be lower as compared to Adani. So this is the one thing. So what interest consists of the market interest rate plus the credit spread, plus you can say the liquidity also, how liquid, like miss if you want to sell it, so how easily you can sell it in the market. So that is a liquidity. Okay, these three things are there, or maybe one more factor. So once we will be going through, so then we will be covering it. So in the SPPI, if uh, whether it is the in this only the interest and the principal is there. Okay, so that is it is talking about. So this we will be uh, discussing later also in this in detail. So in the SPPI, like if you have issued any loan whose um, principal repayment, okay, at the maturity, principal repayment at the maturity is determined through the price, through the equity price, through the share price of that borrower. Okay, and say here the borrower is Adani, Adani Limited, Adani Enterprise, and bank say ICICI Bank has given the loan. Okay, and so here like if the principal amount at the maturity it is like it is uh, determined on the basis of the share price of that borrower. So here this SPPA test is getting failed because this principal it is getting impacted through the share price also through the equity. Okay, so it's not purely uh, on the basis of the interest rate. So it is not there. Okay, so then this SPPA test it is getting failed. Like, but similarly, okay, so here also one more factor is there. The inflation also you can add it. Inflation of that domestic country. Okay, but here instead of the share price, if it is like principal is getting is determined through the inflation factor. Okay, so then it will be a SPPA test. So just I'm giving a very high level uh, overview what is there in the business model and the SPPA test. So now just quickly read through. This is like theoretical, but yeah, but it's very important from the practical point of view because you need to determine at the beginning. Okay, so hardly the institute is asking any question on it, but yeah, but at a high level, you should know about what is there in the business model test and what is there in the SPPA test. The solely payment of the principal and the interest. Okay. So now quickly we will be reading. So business model test. So an entity's business model refers to how an entity manages its financial asset in order to generate the cash flow. Okay. Just a minute. Yep. Yep. So business model is what? How that financial asset is generating the cash flow. So this is what I was just talking about. So here the business model, if the bank is giving a loan to the customer, so then uh, that whether the bank, so from the loan, the bank is getting the interest and the principal. Okay, so that is a cash flow that you're talking about. So this is a business model. So it's not at the transaction level, it is at a very high level, means it is at the entity level. That is at the portfolio of the financial instruments, you can say. So an entity's business model for managing the financial asset is a matter of the fact and not merely an assertion. Okay. It is typically observable through the activities that the entity undertakes to achieve the objective of the business model. So it is not like what entity is asserting. So it is observed through how the entity is undertaking the activities कि मतलब वो एक्टिविटी वो उस एसेट को कैसे मैनेज कर रही है उसके बेसिस पे आप क्या कहते हैं ये डिटरमिन करते हो ये ठीक है and an entity will need to use a judgment यहाँ पे judgment क्यों because this is a judgment related only when it assesses its business model for the uh, managing the financial asset. This assessment is not determined by a single factor or the activity. Instead, the entity must consider all the relevant evidence that is available. Such relevant evidence includes but is not limited to ये एक सिंगल फैक्टर पे डिटरमिन नहीं करता है सो दिस इज लाइक योर कि बहुत सारे आप क्या कहते हैं फाइनेंशियल एसेट्स हैं काफ़ी सारे आपने लोन दे रखा है आप फिर उसको देख रहे हो कि उससे आप क्या कहते हैं जो बैंक जो है वो अपना कैश फ्लो कैसे जनरेट कर रहा है वो कैश फ्लो या तो हेल्ड फॉर सेल के थ्रू कर रहा है या फिर सीसीएफ के थ्रू कर रहा है या फिर मिक्स के थ्रू कर रहा है ठीक है तो उसके बेसिस पे रहता है ओके यहाँ पे जस्ट मैं एक और ऐड कर देता हूँ प्योरली एचएफएस अगर प्योरली एचएफएस रहेगा दैट इज ए मॉडल 3 देन इट इज योर एफवीटीपीएल बिकॉज यहाँ पे आप क्या कहते हैं आपका इंटेंशन है कि बाई सेल करना है और उससे आपको प्रॉफिट कमाना है ठीक है तो वो आपका फेयर वैल्यू थ्रू पीएनएल के थ्रू आएगा सो दिस इज योर ट्रेडिंग activity you can say in a in a local like means in a common parlance the trading for the HFS held for sale. So quickly, so how the performance of the business model and the financial asset held within that business model are evaluated and reported to the entity's key management personnel. क्या वो जो बिजनेस मॉडल है, जैसे ये वाला बिजनेस मॉडल है, इससे आप जो अपने इंटरनली जो आपका जो मैनेजमेंट है, आप उसको कैसे रिपोर्ट कर रहे हो कि ये मेरा मॉडल कैसे परफॉर्म कर रहा है, ठीक है, तो उसके बेसिस पे आप डिटरमिन करते हो टू द की मैनेजमेंट पर्सनल। ओके, देन ये आप परफॉर्मेंस कैसे डिटरमिन कर रहे हो अपने बिजनेस मॉडल का, ठीक है। एंड द रिस्क, दिस इज वेरी सब्जेक्टिव बट या बट हैव ए पेशेंस बिकॉज दिस इट इज डन प्रैक्टिकली in the real world. You should know about it, all these things, because what I have seen that in the classes nobody is teaching in such a detailed manner, but yeah, it's very important to go through the study material because you are giving the exam of the ICA, so you should know each page, each and every word about what is written in the CA Institute material, at least at a high level. Okay, so the risk. So here the performance is there, and here it's a risk. So, okay, just a minute. I will just highlight so that means you can remember this thing as a keyword. Okay. So in the second point, you need to focus on the risk. So how you are managing the risk of that particular financial product. Okay. So the risk that affect the performance of the business model in a particular way, the way in which those risks are managed. So how the risks are managed here. So like what I have said, like in the model one, you are not you are immune to the fluctuation of the market interest rate here, correct? Because you are holding till maturity, so you are not selling in between. तो आप वहाँ पे जो भी मार्केट इंटरेस्ट रेट जो फ्लक्चुएशन हो रहा है इन बिटवीन, अब उससे आपको कोई फर्क नहीं पड़ता है, बिकॉज एट द एंड you will be reaching to the principal amount, your redemption value at the end. Okay. uh, but here in this model, in the model 2, आप यहाँ पे market interest rate से impact हो रहे हो, so this is a risk, so market interest rate is a risk here. Okay, but normally the risk, it is categorized in broadly in the three this thing, um, your market risk, then second is your operational risk, and the third thing is your credit risk. Okay, थर्ड थिंग कि जो मैनेजर है, मैनेजर को क्या कहते हैं, रेम्यूनरेशन कैसे दिया जा रहा है, सो दैट इज ऑल्सो अनदर फैक्टर। सो ऑन द बेसिस ऑफ दीज थ्री थिंग्स यू डिसाइड, लाइक मीन्स कि जो आपका जो असेसमेंट है, जो आपका बिजनेस मॉडल है, वो कौन सा वाला है, या मॉडल वन है, मॉडल टू है, या मॉडल थ्री है, ठीक है। हाउ द मैनेजर्स ऑफ द बिजनेस आर कंपनसेटेड, फॉर एग्जाम्पल वेदर द कंपनसेशन इज बेस्ड ऑन द फेयर वैल्यू ऑफ द एसेट्स मैनेज्ड और द कॉन्ट्रेक्चुअल कैश फ्लो, करेक्ट। अगर फेयर वैल्यू के बेसिस पे रहेगा तो उसमें मॉडल टू या मॉडल थ्री आएगा, और आपका कॉन्ट्रेक्चुअल कैश फ्लो के बेसिस पे रहेगा तो फिर वो आपका मॉडल वन हो सकता है, ठीक है। अगर दोनों के बेसिस पे तो फिर तो आपका मॉडल टू हो जाएगा। ओके, सो लेवल ऑफ द एग्रीगेशन ऑफ द एसेट्स फॉर डिटरमाइनिंग द बिजनेस मॉडल। यहाँ पे क्या हो रहा है कि जो एसेट्स है, क्योंकि ये जो बिजनेस मॉडल है वो एक सिंगल ट्रांजेक्शन पे नहीं रहता है। ओके, ये आप ये ध्यान रखिएगा, ये सिंगल मॉडल के बेसिस पे नहीं रहता है, सिंगल एसेट के उस पे नहीं रहता है। ये आपका आप क्या कहते हैं, जो सिमिलर एसेट्स है कि आपने ऐसे लोन्स दे रखे हैं, तो लोन्स आप एक उसको लोन का एक पोर्टफोलियो बनाते हो, जैसे कि ठीक है, ये सारे बहुत सारे क्या कहते हैं लोन्स हैं जो से मान लो, जैसे कि क्योंकि बैंक जो है वो तो ऐसा है नहीं कि एक सिंगल लोन देता है, वो तो नंबर ऑफ लोन्स दे रहा होता है। तो उस से मान लीजिए से मान लीजिए अगर वो 1000 नंबर ऑफ लोन्स है, ठीक है, आउट ऑफ दिस 1600 जो नंबर ऑफ लोन्स हैं, उसके लिए वो क्या कहते हैं मॉडल वन फॉलो कर रहा है। सिमिलरली जो रिमेनिंग है उसके लिए क्या कहते हैं, से मान लीजिए यहाँ पे 300 क्या कहते हैं जिसके लिए वो मॉडल टू फॉलो कर रहा है, ठीक है, मॉडल टू फॉलो कर रहा है। और थर्ड जो रिमेनिंग है 100 के लिए वो कहते हैं मॉडल थ्री फॉलो कर रहा है, ठीक है। मॉडल वन आपका क्या था, एमोटाइज कॉस्ट, जिसमें केवल आपका सीसीएफ रहता है, कॉन्ट्रेक्चुअल कैश फ्लो रहता है। और मॉडल टू क्या होता है, जिसमें आपका क्या कहते हैं, ये एफ से आता है, जिसमें आपका सीसीएफ भी रहता है और हेल्ड फॉर सेल भी रहता है, एचएफएस, सॉरी। और मॉडल थ्री वेयर यू आर जस्ट फॉलोइंग ओनली द एफटीपीएल, सो एफटीपीएल where only HFS is there. Okay. So an entity's business model is determined at a level that reflects how the group of the financial assets are managed together to achieve a particular business objective. So group of the financial asset it is talking about. Okay, to achieve. So this modeling it is this business model and the SPPI test it is only applied on the financial asset, not on the financial liability. Just keep it in mind. Okay, so an entity's business model is determined at a level that reflects how the group of the financial assets are managed together to achieve a particular business objective, not based on the management's intention to for an individual instrument. So individual instrument के basis पे determine नहीं होता है, ये आपका group के basis पे determine होता है, group of the financial asset. क्योंकि business model जो होता है वो आप at a entity level देखते हैं. Accordingly, this condition is not an instrument by instrument approach to classification and should be determined at a higher level of the aggregation. However, a single entity may have more than one business model for managing its financial instrument. वो हो सकता है कि एक single entity से like ICICI बैंक है, ICICI बैंक it is having the all these three different models it consists of, correct. So consequently the classification need not be determined at the reporting entity level. इसका मतलब ये हो गया कि एक entity केवल एक ही मॉडल फॉलो नहीं करती है, वो ये तीनों मॉडल भी फॉलो कर सकती है, एक भी मॉडल फॉलो कर सकती है, दो भी मॉडल फॉलो कर सकती है. Okay, for example, an entity may hold a portfolio of the investment that it manages in order to collect the contractual cash flow. Contractual cash flow. So, like for the loan, you are having a contractual cash flow is what? Your interest and the principal. And the another portfolio, the investment that it manages in order to trade to realize the fair value. So, trade means your model 3 FVTPL, that is a held for sale. Okay. So, this is the level of the aggregation. So, level of the aggregation for the determining the business model. So, business model it is applicable on the group of the assets, on the group of the financial assets. Okay, it's not applicable on the one instrument. Okay, and determining the basis of the realization of the contractual cash flow. Okay, so entity's business model determines whether the cash flow will result from collecting the contractual cash flow. So contractual cash flow आप हमेशा बस ये सोच के चलिए आपका इंटरेस्ट और प्रिंसिपल अमाउंट. ओके, और सेलिंग द फाइनेंशियल एसेट्स और बोथ. सेलिंग मतलब जो आपका वही एच हो गया या फिर आपका बोथ हो गया. अगर केवल CCF so then you are having amortized cost. ओके, एंड सेलिंग द फाइनेंशियल एसेट अगर है केवल तो फिर वो मॉडल 3 हो गया, बट इफ इट इज बोथ सो देन मॉडल 2 हो गया. ओके, सो दिस कॉन्ट्रेक्चुअल कैश फ्लो जो है इसमें जो इंटरेस्ट और प्रिंसिपल रहता है केवल यही रहना चाहिए, वो आपका SPPI टेस्ट बताता है. सोली पेमेंट ऑफ प्रिंसिपल एंड इंटरेस्ट वो बताता है ये कॉन्ट्रेक्चुअल कैश फ्लो का. ठीक है. So consequently, this assessment is not performed on the basis of scenarios that the entity does not reasonably expect to occur, such as so-called the worst case or the stress case. इसका मतलब क्या बोल रहा है कि नॉर्मली जो आप जो अपना बिजनेस मॉडल डिटरमिन करते हो वो आप क्या कहते हैं नॉर्मल सिनेरियो में डिटरमिन करते हो कि ठीक है कि मार्केट नॉर्मली चल रहा है. ठीक है, आप ये कोई कभी भी बिजनेस मॉडल इस बेसिस पे डिटरमिन नहीं करते हो कि जैसे आज सपोज मैंने लोन दिया और कल ही वो डिफॉल्ट कर जाएगा. क्यों? क्योंकि मार्केट क्या कहते हैं फॉल कर गया, मार्केट में रिसेशन आ गया. तो आप उस बेसिस पे कभी भी आप अपना बिजनेस मॉडल यू आर नॉट डिटरमाइनिंग इट, सो यू आर डिटरमाइनिंग योर बिजनेस मॉडल ऑन द बेसिस ऑफ द नॉर्मल सिनेरियो, करेक्ट. तो अगर सपोज स्ट्रेस केस में भी अगर आपने कुछ क्या कहते हैं कुछ अपने एसेट्स जो बेच दिए विच आर कमिंग अंडर द amortized cost, देन ऑल्सो इट्स नॉट लाइक कि आपने वो मॉडल वो टेस्ट फेल कर दिया है कि भाई मेरा CCF वाला टेस्ट फेल हो गया, ऐसा नहीं है. अगर स्ट्रेस केस तो वेरी विच इज़ वेरी रेयर, तो वो एक्सेप्शन हमेशा अलाउ रहता है कि इन एक्सेप्शनल केसेस यू कैन सेल इट. ओके, फॉर दिस amortized cost asset also. For example, if an asset if an entity expects that it will sell a particular portfolio of the financial asset only in the stress case scenario, That scenario would not affect the entity's assessment of the business model for those assets if the entity reasonably expect that such scenario will not occur. Okay, because your business model you're determining on the basis of normal scenario, not on the basis of the stress scenario. Correct? I think it is making sense. Now coming to the difference in the actual realization from the business model. तो ये जो बात कर रहे हैं कि आपने ऐसे कुछ अगर अपना एसेट बेस्ड है सो इफ लाइक द मॉडल वन टेस्ट से like means the model 1 means amortized cost means if you have sold it, so then will it be a breach or will it require the reclassification from the amortized cost to the FVTPL or FEOC, all those things, correct? So if the cash flow are realized in a way that is different from an entity's expectation at the date that the entity assess the business model. For example, if the entity sells more or fewer assets than it expected when it classifies the asset, that does not give rise to the prior period error. Okay, so it's not a prior period error in the entity's financial statement, nor does it change the classification of the remaining financial asset held in that business model. That is, those assets that the entity recognized in the prior period still holds, as long as the entity considered all the relevant information that was available at the time it made the business model assessment. Like suppose in your model one, okay, in your model one, around 10 loans are there, okay, and out of this 10 loan, you have sold two loans. Okay, maybe because of the stress case, or maybe because means the stress in the market, or maybe because the loan which are given to the customers, so their credit rating is deteriorated, is reduced. So that means your the credit risk has increased of that customer. Okay, credit risk has increased of that customer, and because of that thing, you have sold that two loans. Okay, so now the remaining eight loans. So on this eight loans, will you be doing the reclassification or the prior period adjustment? Okay, it's a prior period error. So for this one, is it a prior period error? Because if it is classified under the amortized cost and you are selling it before the maturity, so then will it be coming under the FVTPL? So this is called a prior period adjustment. Okay, and for the remaining eight loans, uh, will you be reclassifying from the amortized cost to the FVTPL? So those things it is talking about. So if it is like if these two loans are sold because of in the stress case scenario, or if the credit risk has increased of that customer, so then there is no need to do the reclassification of the remaining eight loans, and similarly there is no need to do the prior period adjustment from the amortized cost to the FVTPL on the two loans. So this is what they are trying to say. So in the business model, you are having the three things: the level of aggregation, determining the basis of the realization of the cash flows, and if like the purpose for which you have kept it, and but you are defying that purpose. Okay, so then what will be the impact on it? So that the till now the takeaway is there are three business, there are the three models. Model one is your where you are having only the contractual cash flow, that is your the solely payment of interest and the principal. So then you will be classifying it under the uh, amortized cost, or similarly if your purpose is to hold that asset for the contractual cash flow plus held for sale, that is a mixed, then it will be classified under the FVOCA. And the model 3 is if you are holding that asset only for the trading purpose, like to earn the profit from buying and selling of it, so then it will be categorized under the FVTPL, the fair value through P&L. So there the three models are there. Okay, so for this, for the amortized cost, so you are having a two test, that is your business model. In the business model, you are having a CCF plus the SPPI test. Okay, if you are satisfying both these tests, so then the amortized cost will be there. And similarly, FEOCI, in the FEOCI also you are having a business model test is your CCF and plus HFX, that is your mix. Okay, and plus the SPPI test is also there. That the contractual cash flow which is there in this one, so it is only of the interest and the principal. So then, if these two tests are satisfied, then the FEOCA. Otherwise, you have the FETPL, the residual category. Okay. Now the financial asset held for the trading. So now it is talking about what is the definition of the HFT, that is held for sale for the trading purpose. So financial assets held for the trading are defined as those that are acquired or incurred principally for the purpose of sale or repurchase in the near term. Okay, like you're buying and selling within a very short period of time, say within a week or within 2 weeks, all those things. Yeah, and on the initial recognition are a part of the portfolio of the identified financial instruments. So it is talking about the portfolio, and instrument, these instrument, uh, okay. So on the initial recognition, if that particular instrument is coming under that portfolio whose intention is to manage together and for which there is evidence of a recent actual pattern of the short term profit taking. Okay, so this is portfolio. So obviously, this model, business model, it is applicable on the portfolio, not on the instrument to instrument wise. Okay, and one more thing, this SPPI, it is applicable on the instrument to instrument, on the instrument, but this business model, it is applicable on the portfolio, because on the instrument you need to find out whether it's a that instrument is of it consists only of the interest and the principal as a cash flow. Okay, or other derivatives. So the derivatives by default, like means it is coming under the FETPL. So unless that derivatives is relating to the financial guarantee contract. So I will be just thinking to cover one this financial guarantee in a separate video. I think it will be very short video, because here uh, institute they have asked about the one piece of it. So but in the financial guarantee, if you are talking from the banking point of view, so this is also very important instrument to earn their income. Okay, so and in the financial guarantee also you are having uh, different types of it under it. So that I am just thinking to prepare that one video, but yeah, give me some time on it. So the are the derivatives, so other than the financial guarantee or designated or are designated effective hedging instrument. So the derivatives can be designated. So what I've told you, like in the first chapter, this designated word is very important. So uh, designated words, just I'm thinking how to explain. So designated, like by default derivative, if you think it is used for the trading purpose, correct, for the trading purpose, like the options, so buy and sell, buy and sell. But sometimes, so by default I'm saying, so normally it is the FVTPL. But if it is used for the hedging purpose, if it is used for the hedging purpose, so then you are not using it for the trading purpose, you're using it for the hedging purpose. So here if you are designating, so like means you are uh, creating a special, like means the in a special situation, like you can say, or maybe you are isolating from the uh, crowd. Okay, so like if you are using it for the hedging purpose, so then you are designating it. Okay, so then you are designating it, that word will come, designation. करेक्ट. सो लाइक कि आप एफपीटीपीएल पे लेके जाते हो, लेकिन इन स्पेशल केसेस, वो जो स्पेशल केसेस है उसके लिए हम लोग कहते हैं डेजिग्नेटेड वर्ड यूज करते हैं, कि वो नॉर्मल जो आपका जो पार्लेंस है उससे हटा के आप क्या कहते हो उसको स्पेशल केस पे उसका स्पेशल ट्रीटमेंट होता है. तो उसको फिर आप क्या कहते हैं, सपोज इफ यू आर यूजिंग इट फॉर द कैश फ्लो हेज, so this we will be covering under the hedging chapter. So this is the hedging is also very important, and this is like your my favorite topic also. But hardly, but the bad luck is that institute they are hardly asking about it. But from the practical point of view, from the banking sector, in the banking sector, this is very important. So like if the derivative it is used for the cash flow hedge, so in the cash flow hedge, then you are categorizing, then you are classifying that derivative under the FVOCA. ओके सो दिस इज अ डेजिग्नेटेड कि आपने भीड़ से हट के क्या कहते हैं उसको अलग से एक ट्रीटमेंट दिया सो डेजिग्नेटेड सो दिस इज वेरी स्पेशल थिंग एंड दिस इज वेरी पावरफुल वर्ड एंड if it is designated so then if any instrument is designated so then there is no reclassification of it. This is what you can say. Like similarly for the equity instrument, this will be reading uh, uh, like if you're having around 15% stake. So this is very like you're if you're owning 15% stakes in XYZ Limited. So you are like the major what do you say the uh, you are influencing correct. So you are influencing that company also you can say. So you are sitting in the at the management level. So you can impact their decision also of XYZ. So now normally this equity it is classified under the FVTPL. Okay, because here this business model and the SPPI test are getting failed because the SPPI test in the SPPI test it is talking about the interest and the principal. So in the equity you are not having any principal and the and the interest. You are having the dividend. Okay, so that's why so, so it is classified under the FVTPL. But under the special circumstances you can designate under the FVOCA. That is like you are not holding this equity for the buy and sell. Okay, you are not using it for the trading purpose. You are using it like maybe in the future you want to acquire this company. So slowly in a creeping manner you are buying the stake in this XYZ to make it subsidiary. So this is not for the trading purpose. So here you are designating. So you are going out of league and you're designating it under the FEOC. So here this reclassification is also not allowed in the designated one. So that is a drawback in the designation. But it is like miss it is so it's like your two side effects. So one it is giving a benefit that you are going out of league and plus it's the another drawback is not the another the the benefit is that you can classify it under the FEOC but its drawback is that you cannot do the reclassification of it. Okay, so like the reclassification means uh, if your intention gets changed you cannot classify it from the FEOCA to the FVTPL. So that you cannot do it. Okay, so this is very important word designated. So if derivatives by default it is coming under the trading purpose, so that means your FVTPL, but you are designating um for the hedging instrument purpose, like for the cash flow hedge. So then it will be classified under the your FVOCA. Similarly, in the net investment hedging also, you will be classifying this derivative under the FVOCA. But if the hedging, so here this hedging it is of three types. One is a fair value hedge, another one is a cash flow hedge, and the third one is a net investment hedge. So these are the things. So in the net investment hedge, the FVOCA is there. Just at a high level, I'm just telling it. So I'm not going in detail because it will be covered in the upcoming chapters. So like in the dedicated chapter of the hedging, and here also FVOCA, and here it will be FVTPL. Okay. Okay. So trading generally reflects the active and the frequent buying and the selling and the financial instrument held for the trading are normally used with the objective of generating a profit from the short term fluctuation in the price or a dealer's margin. Okay. So that is a trading. It is talking about the trading. What is the meaning of the trading? An entity holds the investment to hold an entity holds the investment to collect their contractual cash flow. So contractual cash flow is what? Interest and your principal normally if it is. So that means the SPPI test is getting passed. So the funding needs of the entity are predictable and the maturity of its financial asset is matched to the entity's estimated funding needs. Okay, just a minute. An entity holds the investment to collect their, okay, the funding needs of the entity are predictable and the maturity of the financial asset is matched to the entity's estimated funding needs. So what it is saying that, um, okay, just first read it, then we will I will explain it to you. The entity performs a credit risk management activity with the objective of minimizing the credit losses. So credit loss it is talking about of the customer to whom that the loan is given. This is what I mentioned in my the first example, the loan to the customer. Okay, so in the past the sales have typically occurred when the financial assets credit risk has increased. Okay, such that the assets no longer meet the credit criteria specified in the entity's documented investment policy. In addition, infrequent sales have occurred as a result of the unanticipated funding needs. So, report to the key management person focuses on the credit quality of the financial asset and the contractual return. So, the entity also monitors the fair value of the financial asset and among the other this thing. So, here we need to decide whether this is falling under the model 1, model 2, or model 3. So first thing for the model one, uh, so it is what it is saying like whenever the funding need means whenever the money need is required, so then it is selling that asset. Okay, like suppose if it is having a surplus cash, okay, and its intention, the entity's intention is to invest that surplus cash in one business, okay, in one business, but for the time being that it is not able to identify that business. So what it is doing that the surplus temporary, so that the surplus cash which is temporary right now, till it identifies the business, it can invest somewhere else also, which are like very uh, risk free or very liquid assets, so that like you can do the investment in the treasury bonds, okay, for the time being. So until, so like suppose you are investing in the treasury bond, and the treasury bond it is having the maturity of say 2 years, but in between if you find that opportunity that okay in this business I can invest, so then you can sell that treasury bond and whatever the money you are getting from that treasury bond selling, so that you will be investing in the business. So from that perspective you need to uh, think about this question. So an entity holds so investment to collect their contractual cash flow, like here in my example, the treasury bond. Okay, so just I'm writing. So this is a balance sheet. So I've just prepared in the T format. So it's a liability, your asset. So T bills are there in this one. So in the T bills, you have done the investment, the temporary investment. The funding needs of the entity are predictable. Like it is anticipating that okay, um, that within 2 years that the entity will find the business opportunity and there it will be investing. Okay, and the maturity of the financial asset is matched to the entity's estimated funding needs. Okay, the entity performs the credit risk management activity. So here it has done before investing in the treasury bill, it has done the credit risk management. Like, miss, is it very risky? If it is risky, then it will means at the time of the need of the money, so it will not able to sell it. Okay, so that the liquidity problem and the credit risk problem will be there. So it is investing in the highly liquid asset and where the credit risk it is as per their credit criteria. Okay, and so this is how they are doing the investment. This is what where they are doing the investment, and here it is saying that their funding needs it match with the your where they have done the investment, where they are doing the investment. Okay, and their performance of that asset. Okay, the treasury bills. It's mainly on the basis of the credit quality of the financial asset and the contractual return. That is your contractual cash flow. So the entity also monitors the fair value. So on it, entity also monitor the fair value of the financial asset. So this fair value is also there for the monitoring. So although the entity considers among other information the financial assets fair value, from the liquidity perspective, that is the cash amount that would be realized if the entity needs to sell it. Okay, the entity's objective is to hold the financial asset in order to collect the contractual cash flow. Okay, so here the fair value it is there, like for the performance. In the performance, you are having your credit risk analysis. You are doing credit risk. Then second thing you are doing the CCF. Okay, and then the third thing is your fair value. So on the so this is how the management is analyzing is assessing the performance of that portfolio. But here the main weightage it is coming from the CCF, the contractual cash flow. So if it is coming, the main weightage it is coming from the contractual cash flow. So then it will be your model one. Okay, so this is what they are trying to justify. So sales would not contradict that objective if they were in response to an increase in the credit risk. Like if the credit risk is there, like if you have classified under the model one, that is in the amortized cost, but then also you are selling that particular instrument because of the increase in the credit risk, so that is also justifiable. Okay, so it will not uh, impact your this amortize. It will not impact your model one for the reclassification. So sales would not contradict that objective if they were in response to an increase in the asset's credit risk. For example, if the asset no longer meets the credit criteria specified in the entity's documented investment policy. Infrequent sales, obviously, these will be your infrequent sales, which will be having a very less amount, okay, resulting from the unanticipated funding needs. Example in the stress scenario, and would not contradict that objective even if such sales are significant in value. Like even if you are selling it in the stress case scenario, then also there is no need for the reclassification, which I told you in the big in the in the upper this in the previously. Yeah. So hence the business model of the company is to collect the contractual cash flow and not realization from the financial asset from the sale of the. So here it will be the model one. It will be followed. Okay, I think you are appreciating all these things. So okay, coming to the second example quickly, an entity's business model is to purchase the portfolio of the financial asset. Again, it is talking about the portfolio. See, business model it is saying no. So that means the portfolio will be coming, such as the loans. Now the loans. If it is a loan, so then it means what? Uh, Loan means your then your the CCF will be interest plus principal, correct? Those portfolio may or may not include the financial asset that are credit impaired. Um, this is also very important thing, but I think institute they have not covered in detail about this credit impaired. So credit impaired means like any loan which is not originated, like means uh, the loan which the banks they are buying. Correct. So like in the if you have seen that in the restructuring or in the special purpose vehicle, like what the banks they are selling their NPAs, correct? So the banks they are selling it to the another entity. So that another entity, so it is buying that NPA. So those NPA, so NPM is what? Where the default has already occurred, where that default event has already occurred. So those are the credit impaired. So it will be buying it at a very cheaper cost, at a cheaper price. So that is what your credit impaired. So these portfolio may or may not include the financial asset that are credit impaired. If the payment on the loan is not made on a timely basis, the entity attempts to realize the contractual cash flow through the various means, for example, by contacting the debtor by mail, telephone, or other method. The entity's objective is to collect the contractual cash flow. So here, if any customer is not paying on time, so then that entity is not selling that loan. So it is what it is doing. So it is contacting to that customer and then asking them like and requesting them to pay your uh, interest and the principal amount. So the entity's objective is to collect the contractual cash flows, and the entity does not manage any of the loans in this portfolio with an objective of realizing the cash flow by selling them. So that means purely it is your CCF, like means SPPI is past plus your in the business model you're having that the CCF holding is there. So these two tests are passed. SPPI that in the CCF you're having interest plus principal. Okay, so SPPI. So okay, so just I'm giving one more example in this SPPI business model test. So like if you're holding the equity, okay, and it is from the long term point of view, it's not for the trading purpose. Okay, so now but in the equity you are getting the dividend, not the interest, not the principal. Okay, and that is at the discretion of that investee. Okay. So so here equity you are having the contractual cash flow, your CCF is your dividend. Okay, so uh, okay, just a minute, I will be writing. Financial instrument is there first. So in this, uh, if it is a loan, okay, and if it is equity, so in the loan you are having the cash flow. This I'm talking from the investment point of view. So that means the bank has given a loan. Okay, and similarly here the bank has done the investment in the equity. So here your loan. So from the loan, what you are getting, that what the bank is getting, interest plus principal. That is your SPPI, interest plus principal. And here it's your from the equity you are getting dividend. So here this SPPI is there. This one the interest and principal, solely payment of principal and the interest. So that means this one. But here it's your it's not your SPPI because you are getting dividend. So this is your CCF. Both are CCF. Contractual cash flow. Contractual cash flow means what is written in the contract that cash flow you are getting. So this is what. So in the contractual cash flow, when you are buying the equity, so it is mentioned in the contract that you will be getting the dividend. And here in the contract, when you are giving the loan, you it is mentioned that you will be getting the interest and the principal. So both are the CCF, but one it is satisfying the SPPA and the another is not satisfying the SPPA. So this is what I mentioned that for the amortized cost, CCF it is coming under the business model. Okay, in the business model. So in the amortized cost, your business model should be your CCF plus your SPPA test should be there. Both should get satisfied. So that means in the amortized cost, only I can conclude only the debt instruments are coming, not equity instrument. Equity instruments are not coming in this one. Only the debt instrument. Debt instrument, loan, bonds, those are coming. Where you have done the investment in the loan or where you have done the investment in the bond. So only the debt instruments are coming because for the amortized cost, this SPPI test. So in the SPPI test means what? In a simple word, your interest plus principal. So here it's so here in the equity instrument, you will see that the SPPA test is not getting satisfied, but you're holding it for the long term. That is for the contractual cash flow. Here the contractual cash flow is your dividend. Okay. So here it can be classified under the FVOCI or FVTPL. Correct. This is what I mentioned. If it is from the long term, then you need to designate it. Otherwise, it will be coming under the FVTPL. So this is very important. So contractual cash flow, it can be dividend or like means whatever Contractual cash flow means what is mentioned in the contract, how you will be getting the cash. So that is what it is talking about. So it can be your interest plus principal or it can be your dividend. So this is what. So this is very important thing because this is very thin line item. So I'm just going in detail. So this is like otherwise it gets very confusing. What is there like the CCF? If it is CCF is your interest plus principal. So then what is the difference between the CCF and the SPPI? Correct. Okay. So if the payment on the loan is not made on the timely basis, the entity attempts to realize the contractual cash flow through the various means. Okay, in some cases, the entity enters into the IRS to change the interest rate on the particular financial asset in a portfolio from the floating interest rate to a fixed interest rate. So this we will be covering in the hedging because here what it is talking about through the IRS. So normally the IRS it is used for converting your fixed rate loan into your floating rate loan. I think this also little bit I have touched upon in my chapter 1. Okay, for the this hedging also. so so this is of the loan. But if it is normally written the contractual cash flow, just think in a very loose manner that it is talking about the interest plus principal here, because I I have explained in a very detailed manner about this one. Because this CCF word it is used in the business model also, and this CCF word it is used in the SPPI also. So how to demarcate it? Otherwise, both will be same. Okay, but just in a loose manner, just keep in the mind that the contractual cash flow it is talking about the interest plus principal. So here, uh, it is not selling it. So that means its intention is to hold, to earn the interest and the principal. That the contractual cash flow. So this it will be classified under the your model one. That is under the amortized cost. The objective of the entity's business model is to hold the financial asset in order to collect the contractual cash flows. The same analysis would apply even if the entities does not expect to receive all of the contractual cash flow. Example, some of the financial assets are created impaired at the initial recognition. So, moreover, the fact that the entity enters into the derivatives to modify the cash flow does not in itself change the entity's business model. So here, like through the interest rate swap, just you are changing the interest, like from the fixed to the floating. You are doing it. So, but again, you are earning the interest. So the interest is there. So like even from the hedging also, like after entering into the IRS also, then also you are earning the interest. But you have just changed the color of it, you can say, from the fixed to the floating. So still you are having that objective of the contractual cash flow to get. So that's why. So here the business model is the your is of the CCF. It is not of your CCF plus HFS or HFS. Okay. Entity B sells the goods to the customer on credit. Okay. Entity B typically offers the customers up to 60 days following the delivery of the goods to make the payment in full. Entity B collects in accordance with the contractual cash flow of the trade receivable and has no intention to dispense of the receivable. So here also like similarly like if you remember like for the financial instrument what I have told you like always prepare the two legs if it is a gross settlement here if it is happening. So entity B to the customer. So customer is this one. So customer entity B has sold the goods. Okay, goods it has sold. Now it has to receive the cash. So this this leg is already performed. Goods one. Okay, and only this one is pending. So it will be a financial asset. For this one for B it will be financial asset and for customer it will be a financial liability because it has to pay the cash. If both the legs are pending, so then it will not be financial instrument. Okay, but here this leg is already completed, so only this leg is pending. So that's why it is coming under the financial instrument. So now it is talking about like okay, so here the B is not having the intention to sell it. So its intention is to collect the cash. Okay, so, and that is also in the 60 days. So it will be categorized under the, so here also the business model is your contractual cash flow. Plus here also you are getting the SPPI test is also getting passed. So just I'm covering the SPPI also because here there is a time value. So time value, it is talking about time value if you are thinking. So then just think about the interest. So for the 60 days. So like suppose if you are getting after 60 days something. So 60 days, okay, 60 days. So here you are standing here. So then you need to discount it. What you are getting at the end of the 60 days. So this you need to discount. So this is called is your significant financing. You can say this is the word, the significant financing. That is the meaning of the significant financing, where your time value factor is coming. That is your in time value factor. Time value factor, that is your interest is coming. So interest factor is coming. So you need to discount it and you need to bring it at the present value of today. And for discounting, you need to take the market interest rate for discounting it. So just I've given you the extra information also in this one. So here the entity B's objective is to collect the contractual cash flows from the trade receivables. Therefore, the trade receivables meets the business model test for the purpose of classifying the financial asset at the amortized cost. Okay. An entity anticipates the capital expenditure in a few years. The entity invests its excess cash in short, okay, and the long-term financial assets so that it can fund the expenditure when the need arises. Okay. So entities is is planning to do some expenditure. So, so that means it's right now it is having the temporary cash in its hand, and it is doing so that temporary cash it is investing in some of the financial asset which will be short in the long term. Okay, so that it can fund the expenditure when the need arises. So when that capital expenditure is identified, that means when that business is identified, so then you will be selling these assets and investing that money in the that business. So many of the financial assets have the contractual lives that exceeds the anticipated investment period. Okay, the entity will hold the financial asset to collect the contractual cash flow, and when an opportunity arises, it will sell the financial asset to reinvest the cash in the financial asset with the higher return. Okay, so suppose you will find that particular business in 5 years for the capital expenditure. So in between, you are doing some investment in the some short term or the long term. So sometimes, like whatever the financial asset you are identified in between, so its life can be say 7 years. Okay, but your business you will be finding for the capital expenditure in 5 years. So then what it is saying that so the the temporary investment which you have done in the 7 years instrument, so this you will be selling it if you are finding some more better opportunity in between. So that means HFS is also coming, held for sale is also coming, plus your CCF is also coming. So entity will hold the financial asset to collect the contractual cash flow, that is your CCF, and when the opportunity arises, it will sell the financial asset to reinvest the cash in the financial asset with the higher returns. So the manager responsible for the portfolio are remunerated based on the overall return base. ठीक है, तो ये बिजनेस मॉडल का जो मैंने क्राइटेरिया बताया था आपको कि मैनेजमेंट को आप कैसे मैनेजमेंट कैसे उसको एसेस करता है उसका परफॉर्मेंस. सेकंड थिंग इज आप कौन सा रिस्क मैनेज कर रहे हो और जो मैनेजर है, ठीक है, मैनेजर को कैसे रेम्यूनरेट करते हो. तो इससे तो ये दिख रहा है कि दिस इज योर FVOCA. Let's see what justification they have given. So the objective of the business model is achieved by both collecting the contractual cash flow and selling the financial asset. Correct. So the entity will make the decisions on an ongoing basis about whether collecting the contractual cash flow or selling the financial asset will maximize the return on the portfolio until the need arises for the invested cash. So that means you're having the business model of collecting the cash flow and selling the financial asset. That is your CCF plus HFS. So that means the model 2. But in contrast, so it is saying that it is creating one exception here. Means it is now going into the another example. It is molding this example. In contrast, consider an entity that anticipate a cash flow in the 5 years to fund the capital expenditure. 5 years. Okay, so 5 years is your for funding the is for the capital expenditure, and invest that excess cash in the short term financial asset. So short term financial asset whose life it is less than 5 years. So when the investments mature, the entity reinvests the cash in a new short term. Okay, so the entity maintains this strategy until the funds are needed. So here this HFS is not there. Held for sale is not there. So here it's purely the CCF is there. Contractual cash flow. Okay, because here your maturity period of the financial asset, the temporary financial asset, it is less than 5 years. Okay, so the entity maintains this strategy until the funds are needed. So at which time the entity uses the proceeds from the maturing financial assets to fund the capital expenditure. So only the sales that are insignificant in value occur before the maturity. सपोज ये 5 साल का है, आपने 2 साल का एक एसेट खरीदा, ठीक है, देन अगेन आपने 2 साल का एसेट खरीदा, और फिर आपने अगेन क्या कहते हैं 2 साल का एसेट खरीदा, तो 2 years, so this is 2 years. So here you need the fund here because for your business purpose, so then you need to sell it. Okay, that's the last one. So you keep on reinvesting, you are not selling it in between. Here, this one, this first instrument, item 1, item 2, and this is item 3, the financial instrument, correct? So this one, from here you are earning through the CCF, here also you are earning through the CCF whose maturity is 2 years, whose maturity is 2 years, so total 4 years. And but plus, but for this one, the instrument 3, when you will be investing that money which you have got at the expiry of this instrument 2, at the maturity, at the expiry of this instrument 2, so that you have done the investment in the instrument 3, but here its life is 2 years, so but you need the money in between, so here you need to sell it. So it is saying that here you are doing the selling for this funding purpose, okay, for the capital expenditure, so don't consider it. Okay, so only the sales that are insignificant in value occur before the maturity unless there is an increase in the significant risk. So this objective of this contrasting business model is to hold the financial asset to collect the contractual cash flow. So here it's a CCF, and here it is CCF plus your HFS, hold for sale, held for sale. Okay, or you can say HFT. So that means this will be coming under your FEOC model 2, and this will be coming under your amortized cost if the CCI it is of interest and the principal, that is if it is satisfying the SPPI test. If it is dividend, then this will not be coming under the amortized cost. Okay, so all these are very small things which you need to understand, but I think now slowly you are getting the hold on the business model and the SPPI. So till now we haven't discussed about the SPPA, but I think from here you are having the understanding about the SPPA also. An entity has a business model with the objective of originating the loans. Originating the loans means it is giving the loan to the customer. So it is not buying the loan from the market directly. It is originating the loan. It is giving the loan to the customer. So this is what it is called as originating the loan. So just try to understand the term also, because we loosely read. So sometimes from the knowledge point of view also you need to see all these things. So an entity has a business model with the objective of originating the loans to the customer and subsequently selling those loans to the securitization vehicle. Okay, SPV. The securitization vehicle is issues the instrument to the investors, and the originating entity controls the securitization vehicle and thus consolidates it. Okay. The securitization vehicle collects the contractual cash flow from the loans and passes them to its investor. So in the consolidated balance sheet, loans continue to be recognized because they are not de-recognized by the securitization vehicle. Okay, so here it is talking about the, okay, so bank, what it is doing, just I'm just telling you the flow. So bank has given number of loans, L1, L2, L3, okay, L4, say LN. So these many loans it has given to the customers. So now, so it is what it is doing, it is making it as a portfolio and it is selling it. So this is the portfolio one. Okay, so now this portfolio, so it is comprising of various loans which has given to the customer. Now the bank, it is giving it to the SPV, the special purpose vehicle. Okay, so in the SPV balance sheet, okay, so just I'm making the balance sheet here also. So it's the T balance sheet. So balance sheet, liability, asset, balance sheet, liability, asset here. Okay, so these loans will be coming here. So just I'm writing it as a P1 here. So P1 it is selling. So this is the separate balance sheet I'm talking about, the separate balance sheet. Separate balance sheet. Separate means separate financial statement of this bank, SFS, not the consolidated one. Consolidated means bank plus SPV will be coming both. Then that will be a consolidated balance sheet. So in its SPV, so this P1, still it is not derecognized because the originating entity controls the securitization vehicle. So so this, you can say this SPV on this, the bank is having a control. So that's why, so maybe you can say it as a subsidiary. So that means still bank is having the, so this is subsidiary. So for the, in the SPV it can be removed. So now uh, so here it will be coming. So this P1 it will be coming here. Okay. So what SPV, so just I'm making the transaction, the bank and the SPV in between. So bank has given the portfolio of the loan P1, and the SPV will be giving the money to the bank. So, and what SPV will be doing? SPV will be issuing the equity or the issuing the shares in the market. Okay, equity. And so whatever the money it will be getting from here, it will be giving it to the bank for this one. Okay, so this will be the balance sheet of the SPV. So from the equity, whatever it is getting the cash, that cash it is paying to the bank, and against that cash, SPV will be getting the portfolio of these loans. So this is a structure SPV. But here the SPV is controlled by bank, so that means at the consolidated level, the bank has to combine both the balance sheet, the separate balance sheet of the bank and the separate balance sheet of the SPV combined. So ultimately in the CFS asset, here the P1 will be coming. So that means it is selling to its subsidiary. So that means, but at the holding level, at the consolidated level, that asset hasn't gone out. Okay. So the entity originating the loan to the customer has the objective of realizing the contractual cash flow on the loan port. So at the consolidated level, the bank has kept this loan. Okay, it hasn't sold it to the outsider, to the third party, not to the external party. So that means still at the consolidated level, so this bank is holding these assets, these loans, and it is getting the cash flows through the CCF. Okay. So the entity originating the loans to the customer has the objective of realizing the contractual cash flow on the loans portfolio only through the sale to the securitization vehicle. Okay. However, at the consolidated group originates the loan with the objective of holding them to collect the contractual cash flow. So hence the consolidated financial statement provides for a business model with the objective of collecting the contractual cash flow by holding to the maturity. And in the SFS of the entity originates the loan to the customer, business model is to collect the contractual cash flow through the sales only. Okay. So in the SFS, the business model will be your FVTPL model 3. Okay, model 3. But at the SFS level of the bank, so bank at the SFS level, separate financial statement, and at the consolidated financial statement. So here the model 3 will be coming, and here the model 1 will be coming. Correct? So this is what they are trying to say. So just see how they have made the example. So they have made it very beautifully, but yeah, you should try to understand it, because the way the institute now they are asking the question like in the AFM paper. So now be ready for this FR also. So that's why just try to absorb what is written in the material at least. Okay. A financial instrument institution holds the financial asset to meet the liquidity needs in a stress case scenario. Example, run on the bank's deposit. So this is very uh, common thing, which is this jargon it is used, run on the bank when the bank faces the issue. Okay, I think it happened for one of the particular bank where the people they start withdrawing their money. So that is called as a run on the bank. So financial institution holds the financial asset to meet the liquidity needs in a stress case scenario. So here the asset they're holding to meet the liquidity needs. Okay, the entity does not anticipate selling this asset except in such scenario. The entity monitors the credit quality of the financial assets, and its objective in managing the financial asset is to collect the contractual cash flow. The entity evaluates the performance of the assets on the basis of the interest revenue earned and the credit loss realized. So its performance it is based on the interest. So that means your contractual cash flow and the credit loss. So however, the entity also monitors the fair value of the financial asset from a liquidity perspective to ensure that the cash amount would be realized if the entity needs to sell the asset in a stress case scenario would be sufficient to meet the entity's liquidity need. Periodically, the entity makes the sales that are insignificant in value to demonstrate the liquidity. Okay, so periodically it is selling the asset, but not of a very small amount. Entity is selling the some asset of a very small amount, just to check whether that liquidity is there or not. Okay, just for the checking purpose. So ultimately, okay, so just read the, so from here it is like the stress case. So the stress case, so what I've told is the normally the business model, it is not uh, prepared on the basis of the stress case. It is prepared from the normal scenario. Okay, so in the normal scenario, it is like you're holding the asset to collect the contractual cash flows. So it is looking like at a superficial manner. So it's your contractual cash flow test is getting satisfied. Okay, now let's see if they tweak the example further. So the objective of the entity's business model is to hold the financial asset to collect the contractual cash flow. The analysis would not change if during a previous stress case scenario the entity had sales that were significant in the value. So this is your exception. So means if you are selling it in the stress case or where there is a credit risk has increased, so then in those cases you can sell it even if you are holding the asset for the CCF purpose. So here there will be no need for doing the reclassification. Okay, so if the during a previous stress case scenario the entity holds that was significant, so that in the stress case you can sell it. Recurring sale activity that is insignificant in value is not inconsistent with the holding the financial asset to collect. So and the recurring sales. So this one it is talking about. So recurring sales. So you are doing the sale which is of very insignificant value. So this is also allowed. So just you are checking the liquidity of it. So that is also allowed. So even if you are doing the selling of the asset which is hold for the till the maturity, then also if you are doing the selling, and here the selling you are doing in two cases, one is in the stress case and the another is for the testing purpose, then also you are complying the CCF test of the business model. So if the entity and plus if the CCF is your interest plus principal, so it then the model one will be coming into the picture, that is amortized cost. If the entity is required by its regulator, even if okay, if the entity is required by its regulator, now it is tweaking the example that if entity is forced to sell the asset on a routinely manner because of the regulator to routinely sell the financial asset to demonstrate that the assets are liquid and the value of the asset sold is significant, the entity's business model is not to hold the financial asset to collect the contractual cash flow. So because of the regulator and plus that selling is of the significant value, so then it will not be satisfying the this CCF test, the contextual cash flow test. Whether a third party imposes the requirement to sell the financial asset or that activity is at the discretion is not relevant to the analysis. Okay, the entities is sold in the entity's business model is not to hold. Uh, so in contrast, if an entity holds the financial asset to meet its everyday liquidity needs, and meeting that objective involves the frequent sales that are significant, and the objective of the entity's business model is not to hold the financial asset. If you are selling it on a daily basis to meet the liquidity, so that means you're just your intention is now it is not for holding it for the contractual cash flow. It is just like your hold for sell, that is hold for trading purpose. Okay. Now coming to the contractual cash flow characteristic test. So this contractual CCF, its another name is SPPI test. Solely payment of principal and interest. Okay. So now Ind AS 109 requires, so the CCF it can be your dividend or it can be SPPI. So it is talking this CCF, it is from this point of view. Okay, here. So IS Ind AS 109 requires an entity to classify financial asset on the basis of its CCF if the financial asset is held within the business model whose objective is to hold the asset to collect the contractual cash flow, or within the business model whose objective is achieved by the CCF and selling the financial asset. That is a CCF plus your hold for sale or your hold for trading, and this is the CCF. Okay. So to do so, an entity is required to determine whether the asset's contractual cash flow are solely the payment of principal and interest on the principal amount. This is the important line. This is the one which I was talking about. Okay. So just think again that the contractual cash flow SPPI, not this one. But yeah, just keep in the mind that it can be dividend also. If it is a dividend, then your SPPI test is getting failed. Okay, the key characteristics of the cash flow of the to the test if they are solely the payment of the principal and the interest are as follows. What is the principal? Principal is what? So principal is the fair value of the financial asset at the initial recognition. Fair value. However, that principal amount may change over the life of the financial asset. For example, if they are repayment of the principal. So like if you're paying the principal not at the bullet point, it is like you are paying the principal at the installment, like in the five installments. So then your principal outstanding, it gets changed. So just for in a very layman language, just think the your principal amount is your face value, face value. Okay. Okay, just quickly this thing. So just I will go into this concept. Um, so this I will be covering later, or I think I will cover it because these three concepts are there. So then it will be easy for you. Okay. So this is a bird eye view, and this is very important. Just think about it because ultimately, uh, okay, this we will cover later. This one second point now. I will be coming to the third concept here. This is very important. So this you need to think. Okay. So here just I've quickly running through this chart and just keep it in the mind because if you are uh, clear about it, so then just it will be cakewalk for you to do the classification, amortized cost, all those things. So these are the final results, which in the colored box, no, these are the final result. And the in the red one, so this is your testing, like yes or no. Okay, like a flow chart, yes or no. So if SPPI test is passed. So that is your passed means your this one the tick mark like this, and if it is failed, so then this is a cross. Okay. So if the SPPI test is passed and the business model is CCF, okay. If the business model is CCF, that is also passed. And here, if that instrument is not designated at the FVTPL, then okay, here the FVTPL is that instrument is not designated at the FVTPL, then it will be amortized cost. So 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 this I have added here because this will be coming and you will get confused. But yeah, so like even if the business model test is passed and the SPPI test is false, so it should be falling under the amortized cost, correct? But as an exception, like this is what I have said, the designated. So you are having a privilege that you can, in spite that both the conditions are satisfied, the SPPI and the business model CCF test are passed, but then also you can classify that under the FVTPL, which is in the special situation. That is the exception you have taken. So here, this is what it is talking about. So if you haven't designated, means you haven't taken the exception, then it will be coming under the amortized cost. Okay. Now coming quickly to this thing, uh, SPPI test is passed, but the business model test CCF is failed. Now then you need to do the testing of business model CCF plus HFS. Okay. If this test is passed, then again, if you haven't taken the special this thing exception, then it will be your FEOCA. If you have taken the special, that is exception, that is FETPL designation, then it will be coming under the FETPL. Okay, I hope this is clear. So similarly here also, if SPPI test is passed, business model test is failed, business model CCF and HFS is failed, then it will be coming under the FETPL. Correct. So this is your residuary category, you can say. If both the tests are failed, simple. If both the tests are failed, SPPI is passed, but these two tests are failed, then it will be coming under the FETPL. Okay. But if SPPI is itself failed, so this is a situation when your contractual cash flow is your dividend. Okay, and here the contractual cash flow it uh, is your interest plus principal. This one, and here is your contractual cash flow is your dividend. So just remember this thing because these are the very small things which you need to understand. So institute they can tweak it maybe in a very in its practical question, or even maybe it can come under the MCQ also. So you should be clear about it. So SPPI is itself getting failed. So that means your CCF is your dividend. Then here also you are taking the exception, that is your FEOCI. So this also I have explained. So here, so FEOCI you have taken. So FEOCI, that means your normally here which instruments will be coming in this one, the equity instrument. Okay. Equity instrument will be coming. So in the equity instrument, if it is from the long term point of view, so then you can take the exception. That is, you can designate under the FEOCA. If you haven't taken, so that means the cross. So then it will be coming under the FETPL residuary. Otherwise, it will be going under the FEOCA. So this is very simplified chart. You should uh, like just keep it in your mind. Okay. So just quickly, in the nutshell, so this one, sorry, till here, it is your debt instrument. Okay. And color, just a minute, I'm just changing the color, it should be clear to you. And if it is, this is then it is your equity instrument. I hope you can understand what I've done. So debt instrument normally, how when it is coming, if you see here, this one, so here this one. So debt instrument, for the debt instrument, your contractual cash flow should be your interest plus principal. So that's why I've taken from here this one. But if your contractual cash flow is dividend, this one, so then it will be coming under your equity instrument. So the equity instrument having the two categories, one is your FVOCI and the FVTPL. You can take away, means you can note it down this thing. So in the equity instrument, you can have the FVTPL as a residuary and the FVOCI when it is coming FVOCI when you are designating, when you have taken the exception. Similarly, in the debt instrument, you are having all the three categories. Okay, so amortized cost when it is coming, when your SPPI test is passed, that is the interest plus principal, and the business model is your CCF, plus you haven't taken the exception of the FVTPL here. So this is the amortized cost. Similarly, for the FVTPL, your interest plus principal CCF test is passed, that is the SPPI test is passed, but plus your business model test is your CCF plus HFS is passed, plus you haven't taken the exception of the FVTPL, then it will be your FVOCI. Otherwise, it will be FVTPL. So here this FVTPL, it is coming under the exception in this one. But here this FVTPL, it is coming as a residuary. Exception means here designated. Normally this designated word, it is coming for the accounting mismatch. This I am just keep it in mind. This will be covering accounting mismatch. So here this designation, this exception you can take only when there is accounting mismatch. Similarly for here also, if there is a accounting mismatch is there, then only this exception can be taken. But here this exception you are taking for the equity instrument if you are holding it for the long term purpose, not for the trading purpose. See, so just keep it in mind when you are taking the exception. So these are very small things which nobody will explain you, but just keep it in mind. It will be very easy for you to understand about it. Yep. So coming back to the material, because I have taken a lot of time, but yeah, I think, but it is worthwhile. Okay, so principle it is explaining. So now it is talking about the interest. So this is what I have told you. So what is the component of the interest element? So what I have told you, that the simple interest, that is a time value factor, time value factor, that is your interest which is going in the market interest. You can say market interest rate. Okay, just I am changing the color of the pen. Okay, and then your credit spread plus your liquidity factor, and then one more thing was there, no? Yeah, even the profit margin is also there, plus uh, I think that's it. Maybe just we will keep on adding. Okay, so these are the main things. So on this basis, your interest is governed. So the contractual cash flow that has a solely payment of principal. So it is talking. So just think about the contractual cash flow here. It's your SPPI. So the solely payment of the principal and interest on the principal amount outstanding are consistent with the basic lending arrangement. So this is the basic lending arrangement, and originated or a purchased financial asset can be a basic lending arrangement irrespective of whether it is a loan in its legal form. So in the basic lending arrangement, the consideration for the time value of the money and the credit risk. The credit risk, what I've said, the credit spread are typically the most significant element of the instrument of the interest. However, in such an arrangement, the interest can also include the consideration for the other basic lending risk, uh, example, the liquidity risk, and the cost, for example, the administrative cost associated with the holding the financial asset for a particular time period of the time, and the profit margin. Okay, that is consistent with the basic lending arrangement. So, profit margin. So, what the bank, they are adding some spread to earn the profit also. Otherwise, the bank cannot run on the charity. Yep. It's in the extreme economic circumstances, interest can be negative. So this is talking like telling you about like if it is a negative interest rate, so then what is to be done? So like normally it was seen in Japan earlier. In extreme economic circumstances, the interest can be negative if for example the holder of the financial asset either explicitly or implicitly pays for the deposit of its money for a particular period of time. Okay, and the fees exceed the consideration that the holder receives for the time value of the money and the credit risk and the other basic lending risk and the cost. So just for the reading purpose. Okay, nothing big here. However, the contractual terms that introduces the exposure to risk or the volatility in the contractual cash flow that is unrelated to a basic lending arrangement. Okay, introduces the exposure. Exposure, you can say like like my interest, it depends on the inflation factor also, or maybe it depends on the sensex how it is performing. So here if it is dependent on the inflation, so inflation, yeah, so the inflation factor. Okay, so if it is depending on the inflation, so then it is relating some sort of relating to your interest. But if your this exposure, if it is uh, getting amplified, if it is getting leveraged on the basis of your sensex, so then it's not relating to the interest, okay? Because there the this equity factor is coming into the picture. So this is what they are trying to say. The contractual terms that introduce the exposure to the risk or the volatility in the contractual cash flow that is unrelated to the basic lending arrangements, such as the exposure to the changes in the equity prices or the commodity prices, do not give rise to a contractual cash flow that are solely payment of the principal and the interest. Leverage is a contractual flow characteristic of some financial asset. Leverage. Leverage, I hope you understand the leverage, correct? So leverage like taking the debt, or you're leveraging your exposure, like if you're taking the derivative, so then with the limited amount of investment, but you are taking a amplified big risk of the exposure. So that is your leverage. Okay, leverage is a contractual cash flow characteristics of some financial assets that increases the variability of the contractual cash flow, because the leverage, if it is coming in between that the exposure point, so like the derivatives, if you can say, so in your contract, if it's your hybrid instrument where you are having a host contract plus your embedded derivatives. So embedded derivative, what it is doing, it is leveraging your exposure, it is amplifying your exposure. Okay, so that increases the variability of the contractual cash flow. So this embedded derivative and the host contract, the hybrid instrument, this I've already covered in the my the compounded financial instrument lecture. Maybe you can touch upon that thing. So the leverage is a contractual cash flow characteristic of some financial assets that increases the variability of the contractual cash flow, with the result that they do not have the economic characteristics of the interest. So standalone option, forward or swap. So see, these are the derivatives. Yeah, standalone derivatives, not the embedded one. So these are the standalone derivatives. Forward and the swap are example of the financial asset that includes such leverage. Correct. So like means with the minimum, with the small investment, you're taking the big risk of the exposure. Okay, like investing 1000 rupee and you are taking the exposure of 1 lakh rupee, like in the option, the call option, the put option, correct? So thus such contract cannot be said to have the contractual cash flow that are only payment of the principal and the interest, hence cannot be subsequently measured at the amortized cost or the fair value through OCA. Yeah. So if the leverage is there, um, so then that is not your CCF test, is not satisfied in this one. Okay. So the takeaways, what is there in the interest, what are the components, the time value, that is your market interest rate, plus your credit spread, that is taking care of the credit risk of that investee to whom you are giving the loan. Liquidity factor like means if you need the money, so then how quickly you can sell that asset. Okay. Profit margin because you want some spread to earn the profit, correct? And plus the inflation also. So these are the things. So inflation, if your underlying is an inflation, so then that is okay. But if your underlying, like the leverage, if it is not the inflation here, then it will not be allowed here. So these are the one, two, three, four, five things you need to keep in the mind. These are the components of the interest rate risk. Okay. So following are the examples of the contractual terms that result in the CCF that are the SPPI. Okay. Outstanding a variable interest rate on the financial instrument, where this rate consists of the consideration for the time value of the money, credit risk associated with the principal amount outstanding during the particular period of the time. Okay. Normally the credit spread, it remains fixed because it doesn't change. But here the time value of money, that is a market interest rate, it can be changed. It can be a floating rate or it can be a fixed rate. And the other basic lending risk and the cost as well as the profit margin. So this is because the variable interest rate is only to provide the lender with the return through the interest based on the market factors. So the market interest rate, which keeps on changing. So that is a floating rate, and no other form of the return on the principal amount of the financial instrument. So it has the characteristics of the return similar to one on a basic lending arrangement, and thus meets the definition of the contractual cash flow data, the solely the payment of the principal and the. So the takeaway here it is like the time value factor. It can be your fixed rate also, or it can be your floating rate also. The floating rate, because floating rate it captures your it the rate keeps on changing. Okay. So that is also allowed because it is focusing on the present market factors. Okay. Then the second point is a contractual term that permits the issuer issuer to prepay a debt instrument or permit the holder to put a debt instrument back to the issuer before the maturity. So it is talking about the options here, the prepayment option, and the prepayment amount substantially represents unpaid amount of the principal and the interest on the principal amount outstanding, which may include a reasonable and additional compensation for the early termination of the contract. So sometimes what happens, like, so in the prepayment option, you need sometimes it is not there in India, but yeah, means in the other countries it is there. Like if you're opting for the prepayment option, so then you need to bear the some penalty also. Okay, so but that amount is very less, so it is allowed. Still, if it is there, so then also, if in any instrument that prepayment option is embedded, so then also it is allowed. So then also it will be your uh, classified under the contractual cash flow. And simple thing, why you are opting for the prepayment option, so it is also governed through the interest rate. So like suppose you have done the investment at a 5% interest rate, but now the interest rate has increased to say 8%. So now so it is a loss for the from the investor point of view because now the interest rate is increased. So it's better to repay that 5%, means to sell that investment of that 5% and again do the investment whatever you have got from selling that 5% investment asset. Okay, from selling that investment of 5% asset and investing it in the 8%. So again, so it is governed through the your interest rate, so it is allowed. Okay, so but here the catch is this, the penalty should not be a huge amount. Okay, so the reasonable additional compensation implies that the party choosing to exercise its option to terminate the contract compensates the other party. Reasonable. So this is what I have said. Exception here, some prepayment option could result in other party being forced to accept the negative compensation. Example, the lender receives an amount less than the unpaid amount of the principal and the interest if the borrower chooses to prepay. Okay, so so this is just keep it as in mind because it's hardly used now. So if if the lender receives an amount less than the unpaid amount of the principal and the interest. Okay, so so then it will not be classified. It so then it will not be like if you're not able to recover your principal and the interest, if you're recovering less than that, so then that means you're not qualifying your contractual cash flow test, correct? So, but here they have now they have changed these rules. So they are saying that even if you're not able to recover your, if you're recovering less than unpaid amount of the principal and the interest, and if it is that not significant, then also you can then also it will be qualified for the CCF. So this is what they are trying to say. So this is for the knowledge point of view. So earlier these instruments were measured at the FVTPL, but now, however, now after amendment, such financial assets could be measured at the amortized cost or at the FVOCA if they meet the other relevant requirements of the Ind AS 109. So to be eligible for the exception, if the fair value of the prepayment feature would have to be insignificant. This is what I've said, insignificant. Even if you are recovering less amount than your principal and the interest, but that the less amount which you are recovering, that should be means the uh, that less amount should be insignificant on an initial recognition. Okay, if this is impracticable to assess based on the facts and circumstances that existed on the initial recognition, then exception would not be available. So that means you need to classify it under the FVTPL. If you are not able to determine that the amount which you are recovering less, how much it is, whether it is insignificant at the time of the inception in the beginning, then if you are not able to do it, so then classify it under the FVTPL itself. Okay, at the current would be measured at the FVTPL. The same would the same would apply if the prepayment amount includes the fair value cost to terminate a hedging instrument. If the amount is inconsistent with the current in AS 109 prepayment rule. So in this, the prepayment uh, the prepayment amount, whatever, like means if you are winding up your the hedging instrument, for that also you need to pay the penalty. So that fair value cost also to be included in this one. Okay. So a contractual term that permits the issuer or the holder to extend the contractual term of, now it is talking about the extension of the maturity period. So that is your extension option is there. So a contractual term that permits the issuer or the holder to extend the contractual term of the debt instrument. The term of the extension option result in a contractual cash flow during the extension period, and that are solely the payment of the principal and the interest on the principal, which may include a reasonable additional compensation for the extension of the contract. Again, if that amount for the extension option, if that amount is reasonable, means it's not big, so then also it is allowed that your CCF test is passed. So this is from the knowledge purpose, but yeah, but you should understand like this is drilling under this prepayment option. So the takeaway is if you have the prepayment option, that if the lender is getting some extra amount first, okay, that is the first case. If it is getting the extra amount because investor, that lender will be reinvesting what it is getting from the holder, so it will be doing at a cheaper rate, correct? So then it's a loss for the lender, so for that it is charging some penalty, but that penalty should not be significant. First thing. Second thing, if if that option is with the holder and it is opting it, and because of that thing, if the lender is not able to recover the principal and the interest amount fully, okay, what it has anticipated in the inception, so then that shortfall, it should not be significant. Okay. And third thing, the extension it is talking about. So in the extension, if you are extending, so this extension option, so that if it is at the market term, then it is good. So then it is satisfying your the contractual cash flow test. But if it is not at the market term, okay, so then the shortfall like means the market term versus at the terms at which you have and agreed to extend it, the difference of it should not be significant. Okay. If it is significant, then it will not be classified under the contractual cash flow. It will not be satisfying the contractual cash flow test. Okay, the instrument A is a bond with a stated maturity date. The payment of the principal and the interest on the principal amount outstanding are linked to the inflation. So this is what inflation index of the currency in which the instrument is issued. The inflation is not leveraged and the principal is protected. So ensure evaluate the context. So this will be your contractual cash flow test. It is getting satisfied. So this you can read because we have taken a lot of time. Okay. So the contractual cash flow are solely the payment of the principal and the interest on the principal amount outstanding, the linking the payment of the principal and the interest on the principal amount outstanding to an unleveraged inflation index. Okay, so this, okay, one thing here first, uh, if this inflation index of the currency, if it is linked to the another country, okay, like suppose you have given the loan in India and this inflation index you are of the currency you are talking about the US. So then it will not be your contractual cash flow test. Means it will not qualify for this one because here the country you're in which you are giving the loan it is in India, but you are taking the inflation index of the US. So this is a mismatch, correct? So that's why it is mentioned the inflation index of the currency in which the instrument is issued. So this is the significance of this line. They see the small things. The contractual cash flow is solely the payment of principal interest. Okay, so linking the payment of the principal and interest on the principal amount outstanding to an unleveraged inflation index resets the time value of the money to the current level. Correct. Yeah. So in other words, the interest rate on the instrument reflects the real interest. Yeah. So it will be a real interest because you are resetting, like it's your floating rate, you can say. So thus the interest amount are consideration for the time value of the money on the principal amount outstanding. However, if the interest payment were indexed with another variable such as the debtor's performance or an equity index, so now here it is based on the another underlying. The contractual cash flow are not the payment of the principal and the interest on the principal amount. Okay, so that is the basic. The contractual cash flow reflects a return that is inconsistent with the basic lending arrangement. So if it is on the basis of the inflation, so that means you are resetting it to the current level. You are coming to the current market risk factors, so which is allowed. So if it is there, so then it will be then it will pass the contractual cash flow test, CCF test. Okay, that is your SPPI test. Instrument F is a okay. Instrument F is a bond. Another example, instrument F is a bond that is convertible into a fixed number of the equity instrument of the issuer. Analyze the nature of the cash flow. So here you're converting your principal into your equity. So that is not your uh, interest. It's not your means that means you're not qualifying this SPPI test because here the interest plus principal it should be in the cash. This is also should be in the cash. So, but here you are giving it in the equity. So that is another underlying. So that by this, it means it is not qualifying this SPPA test. So this is what they have written. The holder would analyze the convertible bond in its entirety. The contractual cash flow are not the payment of the principal and the interest on the principal amount outstanding because they reflect a return that is inconsistent with the basic lending arrangement. That is, a return is linked to a value of the equity of the issuer. Yep. Okay, next example. Instrument H is a perpetual instrument, but the issuer may call the instrument at any point. Is a perpetual, but the issuer may call the instrument and pay the holder the par amount plus the accrued interest due. Instrument H pays a market interest rate, but payment of interest cannot be made unless the issuer is able to remain solvent afterwards. So deferred interest does not accrue. So here your interest payment it is dependent on your this solvency. So that means it is not dependent on your the basic lending arrangement. Correct. So basic lending means interest is your time value plus your credit spread plus your liquidity plus your profit margin plus your inflation. Okay, so these are the basic lending arrangements. It is not dependent on all these things, so that means it will not be your contractual cash flow test. The contractual cash flow tests are not the payment of the principal. The contractual cash flow are not the payment of the principal and the interest on the principal amount outstanding. This is because the issuer may be required to defer the interest payment and additional interest does not accrue on those deferred interest amounts. As a result, the interest amount are not the consideration for the time value of the money. If then, so this is what they're saying. So this is not the contractual cash flow. But if the interest is deferred and on that deferred interest, if you are accruing the interest, then it can be qualified for the contractual cash flow test. Instrument D is a loan with a recourse and is secured by the collateral. Does the collateral affect the nature of the contractual cash flow? No, it doesn't impact. Even if it is secured or recourse, then also it can qualify for the CCF test. But here your interest will be less because your loan is secured. Okay. Uh, Illustration 11. The instrument G is a loan that pays an inverse floating interest rate. That is, the interest rate has an inverse relationship. So, just they are making the peculiar cases to understand about the SPPI test in detail. So, it is talking about the inverse floating rate, like inverse floating rate. So, inverse floating rate, if it is there, so that means you are not uh, satisfying the time value factor. So, that's why it will not be your contractual cash flow test. Okay. So, this you can read. I think. We can stop here. Then I will be covering later on this thing because this is the biggest chapter of this which I have told you. Okay, and this keep this in mind. This it will help to you. This I will cover later on, and this is the chapter. So till now we have covered this thing, this piece only, business model test. Okay, then later on I will be covering this. So I think three or four, three or more lecture will be required for this one because I don't want to rush and this is the foundation. If your foundation is strong, then you can play with the this chapter, this financial instrument because this is the very important accounting standard which will be touching the all the other accounting standards also. If your base is strong, so then you can easily understand the other accounting standards where there will be bringing some complication by having one single adjustment relating to this one of this accounting standard. Yep. If you like this lecture, please subscribe it. If you find it informative, please uh, subscribe and then share it with your friends also so that it keeps me motivated. Yep. Thank you.